Hi guys, our guest today is Chris Wedding. He's an ex-private equity investor, three times founder, professor at Duke University, a climate CEO coach, and a monk. Let's see what we can learn from 20 plus years of experience in climate tech. Today's episode is a little special. Both Chris and I are running climate tech podcasts. The difference is that Chris has been doing it for a lot longer than I have, and he sits on the other side of the Atlantic in the US. So we talk about both ecosystems in the US and in Europe. We give a lot of tips to founders and folks looking to switch careers and go all in on the climate fight. Let's go. Chris, it's really great to have you on the show and to do a simultaneous show that will be featured on both podcasts. So welcome to Climate Insiders.
You're here. Thanks, Johan. Great to be here.
Let's start by saying a few words of why we decided to do that. Right, there's been tremendous momentum on the US and in Europe on the climate tech ecosystem since 2020. And we are representative of each side, and we're exchanged on a regular basis on what we're observing. But we would love to dig in and maybe open this conversation to our respective audiences. And there's a lot we can learn from each other, I'm sure.
Amen.
So let's start with the goal to provide help to founders and investors, but also people on the outside that are looking to make a shift in their career and join the movement. When did it become crystal clear in your mind that you wanted to become a climate tech, full-timer, and you wanted to dedicate all your time to it? You've been in climate for 20 years, but was there one moment in particular where it became clear?
Well, I would say it goes back, even further, perhaps. So the path that I tell is that, when I was a kid, right, elementary school, my nickname was Nature Boy, a name which still applies given the ponytail / man bun, depending on the day, that still sits atop my head.
Yes.
But yeah, undergrad was environmental science major, biology, chemistry minors. I didn't, business and finance and all those things, they were the enemy. They were the quote unquote frat houses I would walk past on the way to my, science building. Luckily things are very, very different now. But yeah, then my path was, let's go study in the rainforest of Panama and Costa Rica, right? That's my path to quote unquote saving the world. And although that was amazing, the diversity and such that you see in places like that, it's really awe-inspiring and depressing, given the rate at which they're still being cut. These being the rainforest. But I came back, and what I realized as I was presenting at scientific conferences and writing academic papers was, I was kind of talking to myself, right, preaching to the choir a little bit. And I just thought, if I'm going to have a bigger impact, I probably need a new skill set. My dad is a CPA, or I guess retired. My dad was a CPA. My grandfather, I didn't think about it at the time, but he was an entrepreneur from his early 20s. He started a small grocery store in a small town in Kentucky with a population of like 3,000 people. He ran it for 60 plus years until Walmart came to town. So I had entrepreneurship and finance kind of in my genes. I'm getting to your question, but the point is, like, a lot of us come from very different paths, right? I think now when I meet folks, they would not guess perhaps that, Nature Boy, environmental science, rainforest ecology was my path, because now most of what I do is, well, let's start companies, let's start NGOs, let's work in private equity or investment banking or whatnot. It takes all those things, right? Or it can take all those things to have the kind of impacts we want. You know this, but I think most of the listeners do too. Climate tech is a newish term, whatever, a couple of years, maybe a little more. Then it was cleantech, or it was sustainability, or for me in my PhD program, and then in private equity, it was green building, green real estate development. Anyway, all those were components, I suppose. I think when I was in grad school and I wanted a client for my master's work, and I learned what private equity was because the CEO was also affiliated with UNC Chapel Hill. I was like, holy cow, so this is what private equity can be. I'm all in, right? Like, let's help move, billions of dollars to, in that case, redeveloping polluted real estate with often green buildings on top. See, I think for me, viewing business and entrepreneurship and finance as tools, right, to address major environmental challenges has been present for a long time. Now the manifestation is climate tech. Hooray, right? Big ass problem, maybe the biggest, but lots of other big problems to tackle. And look, maybe like you, it's super exciting every day to be talking to founders and investors in this space.
Yeah, absolutely. And there's been a turning point, right? A real one in 2021. It started after COVID, 2020, but 2021 was really the major wave building up. So 2021, just in stats, it's $40 billion invested in 600 companies across 1,400 climate investors. There's a real excitement in the street for climate tech, aka startup hubs. My granny is still not talking about that, but hopefully we'll get there. I just wanted to get a reality check from the other side of the Atlantic. So I sit in Berlin, I represent Europe, but how does it compare in the US to crypto, NFTs, the metaverse? Is it on the same scale?
Well, I think it's indicative that we have, mainstream, say, VC firms, right, launching separate climate-focused funds, right? I think it's telling that not every week, but frequently, right, there are new climate funds focused on earlier stage companies being launched. Think, I don't know, Voyager, I believe, is one. Lots of others out there. The numbers I think about are, over $100 billion invested since 2020, and 14% of all VC dollars going to climate tech. So 40%. Those numbers probably have changed since I last checked. I mean, PwC, ironically, has produced a couple of great reports on the state of climate tech.
That's true.
Certainly our mutual friends over at Climate Tech VC do a great job, tracking this. I think it's also interesting to watch or to read some of these the monthly reports coming out of the big investment banking firm Green Tech Nomura. So these free reports that are 40, 50 pages long. They're beyond climate tech, but they cover climate tech as well. Look, I think we'll probably get there in the conversation, but how about now, right? Things are changing, and so as I have both the one-on-one meetings plus the group meetings of the 35 CEOs and investors in our climate mastermind peer groups through Entrepreneurs for Impact, I hear kind of firsthand stories of, well, gosh, how should we be preparing for winter coming? With the recession, talks of recession, expectations of recession, we'd love to believe that public markets are separated from private capital because they're alternative, right? They're not correlated.
That's right.
That eventually they are, emotionally, psychologically, or certainly if you're talking to family office investors, the pie graphs, for those whatever asset bases, they're certainly changing a lot. So I think what I'm hearing from our members is maybe let's raise capital right this very second, because it's going to be worse if our runway ends in 12 months, 18 months. Maybe we're still in a pretty piss poor time to raise.
So does that mean that it has shifted over the last 3 months? So how is the sort of economic downturn has materialized in your day-to-day interactions? Are we already in that winter?
I think I'm not sure let me think about it. Look, the capital's there, right?
Yeah.
Historic amounts of capital raised.
There's a lot of dry powder.
Mostly for venture, right? Not quite, private equity's not quite there yet, not quite mature enough, but the capital's there. And as you know, but many listeners will know, you raise a fund, you've got plus or minus a 4-year investment period. You got to invest the money within 4 years. Mm-hmm. Then you want to harvest within 10, 11 years. But it doesn't mean you have to invest. And so I think that's where the fund managers have this liberty to say, 30 things are crazy. Let's just take a pause. See how low the valuations could get, how much more leverage, negotiating power we might get as fear, doubt, and uncertainty, increase in broader markets. But I guess what I'm starting to hear from both our members and others outside of our mastermind peer group is, look, valuations are tempering, shall we say, becoming more reasonable. And I think many founders say, that's okay. Valuations were pretty crazy. And they were fine. Well, they were mostly fine with that, although some of them said to themselves, let's not push for the highest valuation, because guess what? We got to raise more capital, and you always want to step up your valuation. So if we know we're at the height of capital raising, that could be a problem.
Then you get a down round, and that's problematic.
Yeah.
It is cyclical, right? So as a founder...
I think terms are...
Yeah, it's actually cyclical, right? So as a founder, you're prepared for a long run. So you have to know that at least in every 7-8 years, there's an economic crisis. So you need to be riding that wave as well. And what matters is the end valuation, right? The valuation when you exit through acquisition or going public. Along the way is just a little step, and you just need to recalibrate.
Here. Yeah.
So is there one success story that is in everyone's mind in the US or in North America, where you would say this is a successful climate tech story that is regarded, besides Tesla, obviously, as the company that has beautifully executed, that has gained great momentum, that has gained enormous market share? Or are we still in that immature phase where the winners have not been fully established yet?
Well, the way I want to answer that question is to read out a list of my 35 mastermind peer group members. Of course, that's too long to respond to your question. It's would also force me to pick my favorite children, which is a dangerous territory. Look, I think it's still early to kind of pick.
You're advising all of them.
Yeah, look, it's too early to say like here are the winners, I think. But like anybody can go to like AngelList and search for keywords, right? Whether it's whatever, energy storage or electric vehicles, or pick your term in climate tech. And on AngelList, you will see usually hundreds or thousands of companies in those spaces. And on one hand, amazing, right? We have to diverge before we converge on the winners, but you just know, right, that 95% or whatever the number is of those companies are not going to make it.
Yeah.
So it's both a time of great optimism, but also the sobering reality, right? So we're not at the shakeout, I think, just yet. But as capital becomes more scarce, look, it's going to separate wheat from chaff.
So the outliers have not been fully defined yet. So what you're saying is like there's a great pipeline, right? The funnel is full of amazing companies, great ideas, but the ones down at the bottom, right? The Uber, Airbnb type of where it's sort of that in that phase where it materializes and it becomes a little mainstream has not been settled yet.
No, I don't think so. I think partly it's the kind of what's the maturity of the climate tech space.
Yeah.
Partly, I think for others it's the maturity of the sector, right? So companies working in carbon capture or reuse of carbon or I don't know, green hydrogen. It's earlier days for those spaces and big expectations, but it's too early for the settling to kind of take place just yet.
Yeah, you've decided in 2022 this year to launch a cohort-based course to teach and coach climate tech CEOs. Why do you think there is a gap here in the market, and also what are your observations with regards to the level of maturity of the first time CEOs versus other verticals? Right, it is so new and fresh in climate tech. It requires a blend of technical skill set, but also great execution. What are you teaching them, and where do you see the biggest gap that needs to be filled?
All right. So the reason I started the course, it's on Maven. It's called Fund Your Climate Tech Startup. For me, it's like, look, I run these peer groups for what I call growth stage climate CEOs and investors. So, 35 of them in aggregate, $8 billion in market cap or assets under management. That's cool. And then I have on the way other side of things, I have, a mostly free Coursera course on renewable energy and green building entrepreneurship, a free newsletter at Entrepreneurs for Impact, a free podcast, which we're of course doing now through Entrepreneurs for Impact, a bunch of courses at Duke and UNC, but the middle is huge.
Mm-hmm.
So I thought, well, what can I bring from either of those ends of the barbell to help the gigantic middle? The other reason is that, my first startup, here I was, I'd been in private equity, but mostly I had the kind of sector expertise, and I just made so many mistakes. I knew, persistence is a key success for startups. I was like, damn it, I'm going to persist through everything, except that I persisted through market feedback, which was saying, we don't quite want to pay exactly for what you're offering, right? So for me, it's like, well, let's help first-time founders not make a lot of the mistakes that I made. The other is, having sat in private equity and impact investment banking for so long, I've made I've seen a lot of the mistakes that those who seek capital have made. I made lots of those as I was seeking capital as a founder. So let's help, I don't know, dozens, hundreds of folks each year that are, seed stage, pre-seed, Series A-ish, or they're developing like first-of-a-kind project finance. Let's help them not make those mistakes. So we just started, 32 students around the world, all kind of solution sets, really across the climate space. And we cover the top 20 mistakes that I've seen or made in startup funding. We cover, my 6 favorite sources of climate funding intel. Think, Crunchbase or PitchBook or whatnot. We go through venture capital across a couple of days. So, key terms, leading investors, structures, investor perspectives, kind of what they need. We go through project finance. Then we go through, kind of a 5-step process to raise capital, how to create your one-page business plan a la Lean Canvas or other structures.
That's great.
And then I give them a list of 500 climate investors to go find the right ones, emails, LinkedIn, whatever. It's not going to guarantee that they raise capital, but it's a huge head start to where I was for sure.
Yeah, absolutely. And congratulations, right, for the early success. 32 might turn into hundreds. Yeah. And there's a ton of founders that need that help. Do you, are you aware, and we want to share a lot of resources to all the listeners, are you aware of any other programs that are providing that little kick to get going on climate tech? And we're not talking just founders, we're talking the broad, climate career switchers. I can think of Terra.do, yep. Running an amazing climate tech investing course. There's obviously On Deck, also doing tremendous things on the climate tech side. Any other resources you can think of?
Well, you stole my thunder, Johan. Yeah, I think those two were ones I was thinking about. I went through the On Deck program myself, the second cohort of climate tech. Slack groups, right? I mean, My Climate Journey, where I'm a member, or New Energy Nexus as examples. I have some career switchers in my course as well. So folks that have done whatever, CFO for a public company, or 25 years in big bank finance. But how do you translate that to helping climate tech startups raise capital? I think the various newsletters out there. Again, I reference Climate Tech VC or my newsletter most weeks at Entrepreneurs for Impact. Super short reads, but curation. I don't know. I'll pause there.
That's great. That's great.
So.
And on that note, I just wanted to say to people listening, there's a lot of preconceived misconceptions on the climate tech space, which is you need a PhD, you need to be hyper technical, you need to know about really specific hardware stuff, and that's not at all the case. I would even argue that if you're more of a generalist kind, it's not about skill set; it's more about mindset. It's really tailored for people that are looking for, freedom seekers, the world changers, the purpose seekers, looking to make a shift, and there is a lot of jobs available, and it's only getting going. It's just a start. That is at least how we perceive it in Europe. I had a previous episode with Norscan VC, and they do have a job board listing 600 or 700 opportunities. And it's only the tip of the iceberg, right? We see so many more startups hiring. And as the dry powder gets deployed into more companies, those companies will have to hire 10, 15, 20 employees. And it just creates an amazing, it becomes a Titanic. Not the sinking one, but just the size, the sheer size of that ship.
Important footnote there. Yeah.
And you're probably seeing the same thing, right? Ginormous shift and happening in the job opportunities.
Yeah, I mean, I tell both my grad students or career switchers or young professionals wanting career advice. I was like, look, man, it is. The world is your oyster, right?
Yeah.
I think about the 35 members of our mastermind. It's like they're just on the hunt, right, for attracting and retaining the best talent, and it's super hard right now, and that's reflected in salaries or salary expectations. I mean, certainly inflation doesn't help things, but the high demand for talent, period. But certainly in this space, I mean, if it isn't, I mean, the top two priorities for sure among my members. Look, raise capital, find talent, right? I mean, maybe no surprise, but both things top of mind almost every single month.
Absolutely. And since I want to deliver as many tips and insights as possible, I wanted to do something that is unique on the show. I haven't done that before, and I'm sure it's going to turn well. It's a rapid fire tip. I'm just going to ask quick questions and ask your opinion from your learnings, but also what you're delivering through your course. So the first one is the best strategy to become a founder. Let's say you're an employee, you've already, either young in your career or you've been in a corporate job for a long time. What is the best way to become a founder? Is it to quit your job and go all in, or is it to keep your job and do it on the side as long as possibly feasible?
Well, it certainly depends on how much you have in the bank, but I think the latter scenario. Right. Keep doing what you're doing. But most of us, there are probably ways for most of us to be more efficient with our time, to carve out the space needed to educate ourselves, both in the sector, but also to fill our brains with entrepreneurial thinking. Right. So what books are you reading? What podcast are you listening to? Because those are muscles we train.
Absolutely. And a piece of resource here is the Founder's Dilemma, and I will put everything in the show note. It's a great a great article that just goes over that sort of imposter syndrome and all the elements you need to get things going. The second question is the best strategy to become an investor. Is there one strategy to cut corners and without having to go through MBA and go through the analyst, associate, long graduation? Anything that comes to mind in today's world, where unlimited resources are available?
Well, where I thought you were going with the question is how to invest as a person, which would be the easiest way is through syndicates. Yeah, invest through syndicates, right? Don't worry about building the pipeline, doing the diligence. Put your money into a deal where someone smart is a magnet for deals and can bet the opportunity. And yeah, you give them 20% of the profit if things work out. But if things work out, it's probably going to be pretty darn nice to get 80% of that. Versus a goose egg if you do it all yourself, and a ton more upfront time. But the other way I heard your question was if you want to work in climate investment, and that one I hear a whole lot, certainly from my MBA students. And look, the job opportunities are pretty darn small relative to all the other job opportunities outside of whatever, being in a VC, PE, corporate venture capital group. One piece of advice I give is certainly for grad students, but even if you're, an emerging professional, is to seek out an investment firm and propose to do a free independent study. And don't go blank slate. Right? Come in with like 2 or 3 well researched ideas, make it time bound, make the deliverable super clear, and get to know them and show value through that kind of work.
Very good point.
The other would be, pick a platform, LinkedIn, Twitter, Slack, something, and say a bunch of smart shit on there
Yeah.
about finance in the climate space,
And
right?
develop an audience
niche,
like that.
right? You're going to become the expert in long duration energy storage venture finance, and just read everything, post nonstop. Look, once a day is fine, or a thread a week in Twitter, whatever.
Yeah.
Stand out through your thought leadership. Those might help you.
Very good tip. Yeah, on the latter, I'm fully with you. Right, someone that just fresh out of school already has been in a career for a long time, but is presenting a CV. It's just not going to do any impact. But if you're building an audience, you're building a voice, and it's just, an investor just starts following you, and it feels like a grind, right? This whole social media thing definitely feels like a daily grind, but it pays off. It pays off because you immediately stand out. You have a voice, you're educated, you can definitely contribute to also funds, looking to establish their own brand. So it's immediately valuable. So the next question is now putting on the founder's hat on VC money versus bootstraps. When do you think is the optimal time to raise VC money?
Well, let's just be clear. Not every business that is tackling climate change profitably should raise VC capital.
Mm-hmm.
I mean, just in the U.S. as an example, there are something like 560 new corporate entities formed per month, but most of these are single member LLCs that are doing consulting, some other service, and that's great. Those can be great lifestyle businesses in a very positive way.
Yeah.
Impact, control, etc. So accordingly, far less than 1% of companies in the U.S. receive venture funding. It's a fraction of 1%. If you have like a short sales cycle, for example, or if you have high margin or recurring revenue, those are things which mean maybe you don't have to raise VC. And if listeners are thinking, I can't or don't want to raise venture capital dollars, to have more bosses, if you will, to be expected to have a 100x return. One place to go would be the indie hackers community. So podcasts plus an actual community. And I think for all of them, many are software based, but many are saying not just neutral against raising outside capital. It's like hell no, right? We don't outside capital. Yeah, so that's a path, but you want some proof that there's traction.
Yeah.
Right before you raise capital.
Yeah, it's a good point. I would add just a piece of resource as well. It's an article. I'll link in the show notes. 6 questions you should ask yourself before raising VC money. Really, really on point questions. For example, first one is: can your startup become a $100 million business within 5 to 10 year window? And if it's not the case, you're probably not a VC case. Can your business scale super, super fast? And climate is yet to be seen. If you're not in hyper scalability, you're probably not a VC case again. Also, are you comfortable giving away control and reporting to others? Because that's a misconceived notion that going the entrepreneur's route is the path to freedom. If you go out and raise VC money, look, you're going to have a ton of reporting to do. You're going to have people sitting on your board. You will probably lose majority ownership after 2 rounds. And it's just, you need to be prepared for all this. Yeah,
for sure. I mean, I think the data from, I think, the National Venture Capital Association, or maybe a pitch book, maybe a combo, I think they show, look, you're going to give up, between 15 and maybe 30% each round that you raise capital. Less on the series kind of C, D, E, because you're just scaling. There's less risk, and more in the earlier rounds.
And Chris, since you teach about fundraising in your course, I wanted to ask you, and this is a genuine out of curiosity, would you hire professional consultants to help with fundraising? So are you in favor of hiring someone who is a seasoned consultant to help boost or compress the fundraise if you're a first-time founder?
Yeah. Well, this is a fun question to answer because I was that licensed securities professional doing investment banking in the climate and cleantech space. Look, I think if you're, C, Series A, maybe Series B, you shouldn't use outside help. Maybe Series B if you're just crushing it. But the investors expect the CEO to be look, the
running the
salesman, the
show.
saleswoman, right?
Yeah.
Totally. Now, if you're trying to sell, if you're trying to raise $100 million, if you're trying to sell your company, you have whatever, X megawatts in your pipeline, blah, blah, blah. Then, optimizing, hiring an investment banker, running a real process, getting X number of term sheets to compare at the same time, not to be reactive or over the transom stuff, but proactive, same time, apples to apples comparison. Yeah, and your Series C and beyond, you're probably going to benefit from outside help. Now, looking backwards, there was the last 2 years, so much capital knocking on your door. I think fewer folks chose to have an investment banker help them.
Yeah.
As things get tougher, 12 months from now,
Right on.
Series C and beyond, I think they're probably going to want help. Yeah.
Absolutely. And bouncing back on that one is, do you advise the founders, do you have an exit path or not? Should you define as a founder your most likely exit strategy ahead of time, because that will click with investors? That's what they want to hear. It's part of their own little strategy. Or would you say focus on execution, don't bother about exit yet?
Oh no, I think if you're raising capital, you always need to be thinking about what the exit is, because your investors are, and they want you, who's, whatever. I was going to say chief, but that works for both male and female leaders.
Yeah.
At the helm to be guiding them towards an exit, right? That's how you get liquidity to return to your LPs, your limited partners. I would say that there is another model, right? Some call it, the post-growth entrepreneurship model. Others would say, well, what can you do forever, quote unquote? That's kind of where I am. It's like, well, gosh, I think I could run these climate CEO peer groups and teach these courses on funding climate tech startups and newsletter podcasts teaching you to do like forever, right? I'm 75 years old, just loving this shit. Maybe I work less, but still, we'll still need to solve climate. Anyway, two different models.
Yeah.
Yes, have the exit mind if you're raising outside capital, or you run it as a cash flow business and you do control more of your fate. You may grow more slowly, but maybe you're not looking for the 10x exit, because, by the way, it sometimes doesn't work out.
That's right. Yeah, I would definitely tend to agree with that. And the final question is, and this is especially true for climate tech, because it's a combination. You do have software solutions only, but the vast majority of climate tech solutions are trying to nail some of the biggest CO2 problems out there, and it requires some physical elements, right? So it's typically deep tech hardware with a layer of software. And I found that the founders are typically expert in that small little galaxy of components in their own stack, but past a certain stage, they need to hire a key industry expert, someone who's had 20 years of expertise nailing that particular component. And you need to hire that guy or that girl as a senior manager or middle management. How do you, if you agree, hire those people? How do you attract them, hook them to join your early stage startup to enable scale?
That's a fun one. Well, there are several motivations for why a more experienced person would want to leave their current, probably nice career spot to come join a riskier startup. One could be the upside potential. The other could be more autonomy, creativity. Another could be
purpose,
like legacy. Really, I want to spend my time on things that really matter.
Yeah,
whether it's for me, for my kids, for my grandkids, whatever. I think one factor in that scenario, if you, the founders, are going to bring on more senior executives, sometimes getting very clear through perhaps even different personality assessments or experts who would help you in the interview process, like, will those folks be comfortable reporting to someone younger than them? Or for that matter, I've also heard, reporting to, a black CEO, reporting to a female CEO, et cetera. Like, are they comfortable? Probably not coming from a place where they're reporting to someone who's not like, well, I'm making an assumption there. Yeah. Often those experienced folks coming over as executives are white males, right?
Yeah.
God bless us. However, I've seen that dynamic be a challenge before.
That's true.
But look, we need that let's call it quote unquote gray hair expertise. I mean, there's a podcast I'm listening to right this second through Rich Roll, where it's all about mentoring, and the mentor that the Airbnb founders had, and the role that played, right, to balance out the creativity and like break things of younger founders with the I've kind of been there, done that. Let's learn from each other in this process of growing a company. I think that's a beautiful thing.
Yeah, absolutely. Yeah, building a generational gap. This has never been more crucial now. And again, we're talking, just giving examples, if you're looking at a carbon capture solution that's highly technical, or a hydrogen plant, or a composite material recycling, the exciting part is probably that end goal, right? Commercializing the output feed. But the boring part requires a shit ton of expertise. And we're looking at a company out of Denmark that hired one of the world's greatest facility builders, and he's 60, he's on the verge of retiring, but he's crucial to that project. It doesn't have any of the startup ethos and mentality. It definitely doesn't share any of that sort of mindset, but he's critical in that bringing scale and helping enable that business to materialize growth. So Chris,
right on.
That's it with the rapid fire tips.